on the bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are just about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Sonali, Basak counting you down to the closing bell, here to take us beyond the bell, the global simulcast. We're joined now by Katie Greifeld, doing double the work. She fills in for Carol Masser and Tim Stenovic, bringing together our Bloomberg TV, radio and YouTube audiences worldwide. And we really do digest, Katie, a market that, after a significant sell-off on Friday, just couldn't quite find its footing.
Yeah, it's sort of a listless trade. I mean, we had such a huge macro hit on Friday. It feels like people are just maybe taking a breath here, reevaluating the landscape. You are seeing a little bit of a bump higher in the VIX. We're at a 26 now, but relative to where we've been, doesn't seem that impressive.
Highest since 2007. That's my key headline, of course, as we take a look at two-year yields, up about 3 basis points on the day at 343. Sonali, to your point, though, that further out on the yield curve, actually moves are a little bit bigger when you're rising an additional 7 basis points on the day. So it's interesting to always think about the reaction when you get an equity sell-off day, the flight to quality in Treasury markets versus days like today's when it's more the hawkish narrative that the path to yields is higher.
And are yields or are earnings the bigger story is what I wonder. I look back, I keep on citing it. I think it was a powerful note today out by David Kelly over at JP Morgan. This idea that even though expectations for a bigger rate hike has been a reality, that it's not the moves in the market that you think it would be, where there's more conviction behind that 75 basis point move.
Yeah, the conviction has tallied up a little bit. What does it stand at? About 70% probability that we'll get that 75-bit move as soon as September, but not just the Fed that talks about it, an ECB that starts to discuss the 75 basis point move too. Despite what is another day of losses on the stock markets, a very cheerful New York Stock Exchange as we currently look at people ringing the bell incredibly enthusiastically. That seems to be Teradata with much enthusiasm at the NYSE. The Nasdaq also celebrating what is a day of losses. The Nasdaq off by more than a percentage point, 124 points to the downside. S&P 500 off by 27 points. The Dow off by 183, that's 0.6% loss. And Taylor, the Russell 2000, also off by 0.9%.
One of the sort of bigger underperformers, Caroline, as you mentioned, the Russell, along with the Nasdaq, as you mentioned. I'm going to take a look at sort of the sector level underneath the surface here. And Katie, I think what I love about this is it sort of gives us a broader perspective of the internals of the market. And under that, you really start to see the tilt to the downside, because for the radio audience, even the quote, best performers, there was only 5 sectors. Half of the best performers were still in the red. And so I'll highlight the ones that, of course, are in the green. Energy that we've talked about, utilities, and then food and staples. So a little bit of a defensive tilt when you think about food and staples and utilities there. Otherwise, I migrate down to the bottom of the screen. It's all big tech. Can you believe that? It's media and entertainment, software and services, tech, hardware and equipment, and semiconductor equipment as well. Those sectors were off as much as 2% or so on the day.
And if you dial down to the specific single stock movers, you see that sort of sector picture reflected in the individual names. I'm both Tim and Carol today, so I have both gainers and decliners. The decliners, I mean, it's all big tech. You have Apple, you have NVIDIA, some of the biggest volume names in trading so far today. As of today, it is 4:01 p.m. I guess the market is closed. If you did think about what managed to make it into the green, it was all energy pretty much. You have Diamondback Energy up there. That was the biggest gainer in the S&P 500. And then I threw, Bed Bath & Beyond on there. I don't have a good reason for what we're seeing in Bed Bath & Beyond, but it was up 25%.
Maybe, I think they're
today.
Securitizing Bye Bye Baby to get a loan.
There you go. So a little bit of a fundamental reason, a really give and take sort of meme market when you think about what we saw in some of the OGs today, GameStop and AMC. Nice reminder that there are actual companies underneath these tickers.
And actual liquidity problems and actual banks that they have to turn to. Bed Bath & Beyond, one of your key movers. Let's go cross-asset for a minute, Katie. And what was a key move for me, cross-asset, was the oil market. Look at it. WTI crude up more than 4%. Still sub $100, but we're at $96.94. We saw Brent, of course, move up almost 4% as well. This is much more a supply-side concern. We actually have, despite the hawkish tones coming from global central bankers, an oil market that shrugs it off. off. It's more looking at Libya, the tension rising there, the issue that might have in terms of further supply side curtailment, and indeed, therefore, a market that is also incredibly tight. We see actually some of the metals come off. Overall, copper managed to withstand some of that hawkish narrative coming from central banks. Steel was off by about 2%, zinc off by 1.2%. I'm looking at what happened in FX markets. Now, this was a story of dollar strength. Now, oil market managing to rally even into that market. We saw the British pound off by 0.3%. We await, of course, key data out in the UK. We're looking at Japanese yen off by 0.8%. So no real flight to safety here that's going on. But we did see a euro rally. This is important. It isn't just the Federal Reserve getting hawkish. It is an ECB too. And they managed to push the euro higher. Look at that. We're still at 0.9995. At one point, though, they broke back through parity. And sovereign bonds, I mean, tail of sell-off across the world. This was what the key narrative was. It was European markets, everyone responding to that Jackson Hole speech. Yields sold off, particularly in Germany as well, Taylor.
You saw that here in the U.S. in full faith and credit, Caroline, on the two-year yield, which we've been really highlighting all day, just because getting numbers back to the highest yields we haven't seen, really surpassing June 14 of this year, going all the way back to 2007 is something certainly that we think about. And then, of course, higher yields further out in terms of the move on the day, up now 7 basis points on 10s and 20s, but still only about a 3.11 here on the 10-year yield. Nonetheless, it was sort of a yield higher kind of story, Sonali. We're thinking about all of the yield, the dollar dynamics, and then the move lower in equities and the impacts on the cross asset.
And, you know, I wonder what this really means. We had a guest on earlier today talking about buying at these levels when you look at the 2-year, that it looks attractive still. But I do wonder what it means for the folks that have been telling us all year that duration is the place to start dipping into at the moment.
And if you think about what we heard again from Jay Powell just on Friday, that period of below trend growth that could be a function of them trying to get a grip on inflation, that theoretically should be good for some of those longer dated bonds. Interesting to see them sell off as hard as they are right now, especially it's been most of the action has been in the 2-year yield. I know the size and the scope is more impressive when you think about how high we are, but still a flip of the dynamic.
And I think, I said it already, but I think a large part it was in sympathy with what happened in Europe to an extent and what happened on the German borrowing costs as well. I wonder how much we are going to start to see at any cost. The breathing space Anil Kashkari, a sort of a perma-dove who turns very hawkish, can give to world central banks right now. This is front and center of focus on inflation. And we look towards, hopefully, some sort of steadiness in the labor market here in the US. But the same can't always be said in other economies.
Navigating all of those, I bring you another note from Piper Sandler, some of the economics team, of course, out of there that we often cite on this program, saying that their best estimate of peak funds rates continues to be about 3.25 to 4. But clearly, this is a Federal Reserve, showing that not only, of course, needs to hike aggressively to tackle inflation, but then, of course, how long do they stay there to really make sure inflation comes down before we think about an economy rolling over and then what 2023 looks like?
There are a few unknowns I'm really curious about, this idea of potential cuts into next year and how much divergence is forming around that idea. And then separately, the point that we have been talking about ad nauseum, which is quantitative tightening, and the unknowns around what that means, both in terms of market liquidity and the equivalence of what that means in terms of a further rise on top of the initial rise in rates.
I mean, it is unprecedented that we have the Fed both cutting and quantitative tightening at the same time. It feels like we haven't seen too much disruption. I know there's a lot of concern about liquidity right now, but there's a lot of worried noises going forward that sort of the liquidity profile of markets, that thinning of volume should get even worse. But, you know, we'll see as soon as QT ramps up next month.
And also we know that this isn't a great time of year in general for market losses. September, October, more often than not in the last 25 years, do tend to hand you a healthy loss. Maybe 0.7%. It's generally on average less than a percentage point, but it's still a loss on the month.
And it's volatility that, surprisingly, we think that August is quiet summer dog days, but it's
hasn't felt quiet.
No, it's in every August that surprises to the upside when we think about volatility in VIX.
The volatility tipping higher, I think the reason it matters so much, if that issuance starts to clamp down, then all of a sudden you're thinking again about activity into the end of the year, losses on bank books. profitability declining, and jobs once again. It's quite a vicious cycle, isn't it?
Heavy questions for a Monday. A lot to think about, and a lot to think about ahead of what's going to be a very busy week when you think about what awaits on Fridays with the payrolls data. But in any case, guys, thank you so much for being kind to me as I play both hats here. But in any case, that does it for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. We're going to be back tomorrow at the same time, same place.